Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So I'm continuing the discussion on ratio analysis. So already 3 videos I have completed. The first video I have explained you about the meaning of the term ratio. What is ratio analysis? What are the uses of ratio analysis? What is the importance and limitations of ratio analysis? Classification of ratio analysis. The first video. The second video I have explained you about the liquidity ratio and capital structure ratio. All the formulas I have explained in this second video. The third video I have explained you about the activity or turnover ratio. And this is the last video on theory. And in this video I am going to explain you about the profitability ratios. Remember, the problems are based on the theory. So you should not ignore the theory. If you have watched the theory videos some 2-3 times, then definitely you can be able to understand the problems. Otherwise, every problem will be difficult for you. That's why my suggestion, if you want the complete command on this topic of ratio analysis, watch all the earlier videos. So if you have not watched, I suggest you to go to the playlist of my channel, select the subject financial decision making, select the videos of ratio analysis, watch the first 3-4 videos, be acquainted, perfect with all the formulas and the significance of all the ratios, then only you should come to the problems. So in liquidity ratio, I've explained you about the current ratio, quick ratio, acid test ratio. Then secondly, capital structure ratio or leverage ratio or long-term solvency ratio. We have applied debt equity ratio, proprietary ratio, capital gearing ratio, fixed assets ratio. Then I have explained you about interest coverage ratio, dividend coverage ratio. These are the ratios I have explained under capital structure. Then third one, activity ratio or turnover ratio. I have explained you about the inventory turnover ratio, receivables turnover ratio, payables turnover ratio, working capital turnover ratio, fixed assets turnover ratio. All these ratios I have explained you about the significance and the formula. Now in this video I am going to start the profitability last video on theory. Take a screenshot of the notes which I have written on the board, then I'll explain all the points in detail. Come on. Profitability ratios. The profitability ratios measure the profitability of the concern. See here, every type of ratio will concentrate on a particular function. Like liquidity ratios will focus on the ability of the business to pay the debts on time. Similarly, the capital structure ratios are concerned with the combination of owners fund and outsiders fund. What is the risk involved in the business? Whether the business can be able to run in the long term. That is explained by capital structure or leverage ratios. The third, turnover activity ratios, which are concerned with how effectively the business is utilizing its resources or assets. Now profitability ratios are concerned, what is the profitability of the concern? How much profit the business is earning? So generally, the profitability ratios are calculated either related to revenue or related to investment. So from that point of view, we divide the profitability ratios into 2 categories: general profitability ratios and overall profitability ratios. These general profitability ratios are related to revenue. Revenue means sales. That means profit is related to sales or revenue. Second, overall profitability ratio. This overall profitability ratio relates the profit with the investment. So in this way, related to sales and related to investment. So first we focus on general profitability ratio. That means the profitability ratio which are related to revenue or sales. The first profitability ratio is gross profit ratio. This is the most commonly used ratio. Very frequently used ratio is the gross profit ratio. So it reveals the results of trading operations of a business. The profit of trading operations of a business will be indicated by gross profit ratio. What is the formula for gross profit ratio? It's very simple. Gross profit divided by revenue from operations into 100. What do you mean by revenue from operations? Sales. Sales are revenue from operations. Earlier we call it as sales, now we call it as revenue from operations. So gross profit divided by revenue from operations into 100. So gross profit is equal to revenue from operations minus cost of revenue from operations. So how to find out gross profit? From sales minus cost of goods sold. Revenue from operation means sales. And cost of revenue from operation means cost of goods sold. Earlier we used to call it as sales and cost of goods sold. Now we are calling it, that means the name has been changed to revenue from operations and cost of revenue from operations. Now cost of revenue from operations or cost of operations is equal to, how to find out this cost of revenue from operations? Opening stock plus purchases plus manufacturing expenses minus closing stock. Remember the formula. All the problems are based on the formula. So concentrate more on the formulas. The cost of revenue from operations means opening stock plus purchases plus manufacturing expense minus closing stock. There is no standard or ideal gross profit ratio. The higher the ratio, the more profitable it is for the business. There is no standard ratio, just like standard ratio is given for current ratio, quick ratio, debt equity ratio. There is no such standard gross profit ratio. But the rule is, higher the gross profit ratio, better it is for the business. Now, next one. I have explained you about gross profit ratio. Second profitability ratio is net profit ratio. It indicates the result of overall operations. Here we are taken only core operations, basic operations. But here we will take the overall cost. Net profit ratio indicates the overall profitability of the business. Now, net profit ratio formula, net profit divided by revenue from operations into 100. So revenue from operation. So how to find out net profit? From gross profit, deduct all indirect expenses. The expenses relating to administration, selling and distribution, etc. All indirect expenses will be deducted from gross profit. So we get the net profit or profit after tax. The higher the ratio, better it is. So two ratios I have explained you, gross profit ratio and net profit ratio. The third ratio is operating ratio. So it expresses the relationship between expenses incurred in running the business and the net sales. Net sales or revenue from operations. So what is the formula for operating ratio? Operating cost divided by revenue from operations into 100. So what do you mean by operating cost? The cost of revenue from operations plus administration expenses plus selling and distribution expenses. So remember the formula. Operating cost is equal to cost of revenue from operations. In simple words, cost of goods sold. Cost of revenue from operations or cost of goods sold plus administration expenses plus selling and distribution expenses. This will give you operating cost. And operating cost excludes financial expenses and abnormal losses. So while calculating this operating cost, two things should not be taken. The first is financial expenses like interest paid, finance charges paid. So interest, financial charges will not be taken. Similarly, abnormal losses like loss on sale of machine, loss on sale of furniture, it's abnormal loss, should not be taken. A low operating ratio is an indication of operating efficiency of the business. So a low operating ratio is desirable. If a business is having high operating ratio, it means the business is inefficient. The expenditure is more. Then profitability will come down. So if we have a low operating ratio, it shows the business is efficient. So it is desirable to keep this ratio at a low figure. Then operating profit ratio. It expresses the relationship between operating profit and revenue from operations. The operating profit ratio formula, operating profit divided by revenue from operation into 100. What is operating profit? Gross profit minus operating expenses. Gross profit minus operating expenses. Non-operating expenses should not be considered. That's it. The next one, expenses ratio. Each of the expense ratio highlights the relationship between the particular expense and the net revenue. So many expenses are there. We are relating each particular expense with the revenue from operation. The expenses like salaries. Salaries are related to net sales or revenue from operation. Rent is related to revenue from operation. Electricity bill, that is related with revenue from operation. So every expense is related to revenue from operation. That is called expense ratio. The formula of expense ratio, expense divided by revenue from operation into 100. So these five, gross profit ratio, net profit ratio, operating ratio, operating profit ratio, and expense ratio. These five ratios are called general profitability ratios. Now, overall profitability ratios. In overall profitability ratios, we are relating the profit with the investment. The investment may be made either by the owners or outsiders. In every business, some amount will be invested by the owner. Example, in a joint stock company, the share capital is the owner's fund. Apart from share capital, debentures are there, bank loan, long-term bank loan is there. This is the outsider's funds. So we are relating the profit with the investment. That is called overall profitability ratios. The first overall profitability ratio is return on capital employed, ROCE, or return on investment, ROI. Both mean same. We can call it as ROCE or we can call it as ROI. So this ratio reveals the earning capacity of the capital employed in the business. That means whatever capital is employed in the business, what is the rate of profit we are getting? Percentage of profit on capital employed. So formula ROCE or ROI is PBIT divided by capital employed into 100. PBIT stands for profit before interest and taxes. And capital employed. Now remember, see carefully. Capital employed is equal to equity share capital plus preference share capital plus undistributed profits plus surplus plus long-term loans and debentures minus fictitious assets minus non-operating assets. So remember carefully the formula of capital employed. Capital employed consists of equity share capital plus preference share capital plus undistributed profits plus reserves plus long-term loans and debentures minus fictitious assets minus non-operating assets. This will give you capital employed. In other words, capital employed is the long-term capital invested in the business. All the long-term funds invested in the business is called capital employed. So ROC reflects return earned on every rupee invested in the business, irrespective whether the investment is made by debt or capital. Whether the investment is made by the debt or capital, what is the return for every 1 rupee invested? That will be disclosed by ROCE. So the higher the ROCE, better it is. So every business must try to increase the ROCE to its maximum. Higher the ROCE, better it is for the business. This is the first overall profitability ratio, ROCE, very important ratio. Then second one is return on net worth. So it indicates the return which shareholders are earning on the resources invested in the business. Shareholders are earning on the investment made by the shareholders. Return the shareholders are earning. So formula for return on net worth is PAT divided by net worth into 100. And net worth means shareholders fund. Now what do you mean by shareholders fund? Equity share capital plus preference share capital plus undistributed profits plus reserves minus fictitious assets. So only share capital, whether it is equity share capital or preference share capital, both we are including. So shareholder net worth means shareholders fund. The higher the ratio, better it is. That is the return on net worth. Next is return on equity capital. So it expresses the return earned by the owners. The real owners of the business are equity holders of the business after adjusting for debt and preferential capital. That means after paying off the return on debt and return on preference capital, whatever remaining return is there, the remaining return belongs to equity shareholders. So it is the return which the owners are getting after making the payment on debt and after making the payment on preference share capital. So return on equity share capital, the formula is PAT, stands for profit after tax, minus preference dividend divided by paid up equity share capital into 100. So PAT minus preference dividend divided by equity share capital into 100, this will give you return on equity capital. But some financial analysts argue that we should not calculate the return on paid up equity share capital but equity shareholders fund, because paid up capital means only share capital we are taking, but equity holders are having the stake not only in equity share capital but also reserves, but also surplus. So instead of taking paid up equity share capital, we can take equity shareholders fund. So some financial analyst says the formula will be PAT minus preference dividend divided by equity shareholders fund into 100. The higher the ratio, better it is. So how many overall profitability ratios I have explained here? ROCE, return on capital employed, return on net worth, return on equity share capital. So far we have discussed about the profitability ratios. Those ratios are divided into two categories: general profitability and overall profitability. The general profitability ratios are those profitability ratios which are related to revenue from operations or sales. So 5 ratio, gross profit ratio, net profit ratio, operating profit ratio and expenses ratio. These 5 are the general profitability ratio. Now overall profitability ratios are those ratios where profit is related with investment. So far 3 ratios I have explained. The first one is ROCE, return on capital employed or a return on investment. This ratio is very important. The second ratio is return on net worth. Third one is return on equity capital. Now I am continuing our discussion after third ratio. Now fourth ratio I am going to explain. So totally 10 ratios are there which are overall profitability ratios. So 3 ratios I have just now completed. Now fourth ratio, return on assets ratio, ROA, return on assets. It reflects the return earned by the business on the total assets. The assets consist of current assets and fixed assets. So what is the return the business is getting? What is the percentage of profit the business is getting on the total assets? The formula for return on investment, return on assets, PAT, profit after tax, divided by total assets into 100. Next one is fifth, earning per share. This ratio is also very, very important. Earning per share. So how much earnings each shareholder is getting on their per share. Per share, how much return every shareholder is getting. So it is the earning accruing to shareholders on every share held by him or her. So what is the percentage of earning which every shareholder is getting on per share? So the formula of EPS, earning per share, is profit after tax minus preference dividend divided by number of equity shares. So again I repeat, EPS is equal to PAT minus preference dividend divided by number of equity shares. Don't multiply by 100, it is not percentage. It is simply saying earning in amount per share. The higher the EPS, the better is the performance of the company. That's it. So 5 ratios are completed. Now 6th one, dividend per share. How much the shareholder are getting the dividend on each share held by him. On every share held by him or her, what is the dividend they are getting? That is called DPS. It is the amount of dividend payable to the holder on every equity share. So DPS, the formula is dividend on equity share capital divided by number of equity shares. Dividend on equity share capital divided by number of equity shares. This will give you DPS. The higher the DPS, the happier will be the investor. Investor will be very happy if they get more dividend. So higher the dividend DPS, the happier will be the investor. So 6 ratios are completed. Now 7th one, dividend payout ratio. What is the percentage of dividend paid of the earnings? Actually, dividend will be paid from the earnings. From the earning. For example, if the company earns 10 rupees earning per share, the EPS is 10 rupees. Out of 10 rupees, 4 rupees are declared as dividend. So for every 10 rupees of earnings, 4 rupees are dividend declared. So 4 by 10 into 100, 40%. We can say dividend payout ratio is 40%. So it is the ratio of DPS on EPS. DPS stands for dividend per share, EPS stands for earning per share. So DP ratio formula, DPS by EPS into 100. So this ratio tells us the extent to which the profits earned in the year have been distributed. What is the percentage of profit which is distributed to the shareholders in the form of dividend? That is DP ratio. Next one, a price earning ratio. This ratio is also very, very important. Price earning ratio, it is called PE ratio. It expresses the relationship between market price per share and earnings per share. What is the market price per share and earning per share? Example, the earning per share is 10 rupees and the market price per share is 100 rupees. That means the market price is 10 times of earnings. 10 times of earnings, that is PE ratio. So it expresses the relationship between market price and EPS. The formula for PE ratio is MPS by EPS. Market price per share divided by earning per share. The inverse of PE ratio is called earning yield ratio. If we reverse, if we make the inverse of this PE ratio, what you get is earning yield ratio. So earning yield ratio formula is EPS by MPS. MPS by EPS, you will get a PE ratio. EPS by MPS, you will get earning yield ratio. So totally 8 ratios. The next ratio is dividend yield ratio. Just like earning yield ratio, now we have dividend yield ratio. The formula is DPS by MPS. Here we have taken EPS by MPS. Now we are taking DPS by MPS into 100. This is called dividend yield ratio. Last and final ratio is the book value per share. What is the book value per share? It is that fraction of the net worth of the business as shown in the balance sheet. In the balance sheet of the business, we can be able to find out the net worth. Net worth means shareholders fund. The meaning of net worth is shareholders fund. So from the balance sheet, we find out what is the net worth or shareholders fund. That net worth will be divided by number of equity shares. So net worth divided by number of equity shares, you will get the book value per share. Here is the formula. Book value per share is equal to equity shareholders fund divided by number of equity shares. The higher the book value of a share, the more strong the business is assumed to be. That's it. So 10 formulas I have explained on overall profitability, 5 ratios on general profitability. So totally 15 ratios are there on profitability, highest number. So this is the end of the theoretical part of the chapter ratio analysis. I understand that you will find it difficult to watch all the 4 videos. Totally 4 videos I have given on theory regarding ratio analysis. But believe me, these I have put my 100% effort in explaining each and every ratio. If you understood these ratios, definitely you can enjoy doing the problem. Otherwise, you will be stuck in the problem. So my suggestion to you, my advice to you, according to my experience, I'm saying, whatever, how much effort I have applied, I know it better for your sake, so that you can be able to understand. So watch all the 4 videos with full concentration, not once, twice, thrice. Then only you watch the videos, come to the videos. Inshallah, in the next video, I'll start the problems on ratio analysis.